All right, welcome back. Wait, let me just, I don't know why, don't think the screen is visible. All right, welcome back. Wait, let me just, I, yeah, the screen is visible now, I guess. Let me just check. Okay, yeah, the screen and everything is visible now. Just a moment, I'll be back. Okay, sorry, there were some glitches. So let's begin. So welcome back. I hope you have attended the previous session. Okay, that was on some exam tips and tricks and a brief overview of the FM paper. If you haven't seen the previous video, I would request or suggest that you watch the previous video first and only then start watching this video. Okay. Now, what we are going to do is, as per plan, we are going to discuss NPV and IRR. Now, it will be a 3 hour session. So, whatever we can, I'm not going in depth into NPV in the sense that I'm not doing all the inflation related adjustments, but teaching you the basics conceptually so that it's clear what is NPV and how do we calculate NPV, annuities, perpetuities, all of that. Okay. So, just a quick revision. Now, time value of money. If you remember, in class also we had discussed that well, money has value as per time. So money today is more valuable than money later. Why is that so? Well, there are three reasons for it. One is because of the interest that you can earn. See, if you have money today, say you get 1 lakh rupees today, you can invest this 1 lakh rupees and say in a fixed deposit, and you can earn interest. For example, if the interest is 10%, then after 1 year, this 1 lakh rupees is going to grow to something much bigger, right? So 1 lakh will become 1 lakh 10,000 rupees at 10% interest. And if you are, say, same thing for US dollars, right? If you just deposit your, say, $100 and you are earning 5% interest per annum, then after 1 year, that 100 dollars is going to grow to $105. So this is one reason why money today is more valuable than money later, because you can always invest it today and it can grow. Second one is inflation. It affects the purchasing power of money. We all know that, if we speak to our parents, they'll say, oh, this burger or this sandwich or whatever, this food item used to cost X amount during our time, which is very low. And you feel that, oh no, that can't be true. But it is. Think of it this way: when you were in school or college, what is the price of your favorite sandwich? And what is the price of it now? What is the price of a minimum fare of a cab? What is the fare of the cab right now? It's changed. What is the price of petrol back then when you were in school or college? What is the price of petrol now? So even if you have the same $100, what you could have purchased in $100 10 years back and what you can purchase now is very different. Previously in India, you could have purchased a sandwich for say 10 rupees. Now the same sandwich would cost you 30 rupees. Okay? So that's inflation. The purchasing power of the money would reduce. So money is same, 100 rupees is 100 rupees. But what it could purchase 10 years back and what it can purchase now is different. Okay? And then the last reason is risk. Now, what is this risk? Risk of losing money, risk of not getting your money back. Say, for example, you have invested some money, okay? And there is a risk. What if you do not get your returns? What if you don't get the principal amount back? So, to compensate for this risk, you want more money in return. So, if you're investing, say, 100 rupees, and after 1 year, if you're going to get 100 rupees, it's not worth it. Why? Because for 1 year, you are away from your money. You need to be compensated. What if after 1 year, you don't get your money? Or say in a trade, okay, you have sold goods on credit. Now the customer tells you that after 3 months, I'll make the payment. But what if something goes wrong after 3 months or within the 3 months? You may not get your money. You prefer money today. So what you will do? I'll give you a cash discount. Why don't you pay the money within 1 week's time? Okay. Why are you willing to do that? Because you value money today more because it is less risky. Getting money in 1 week is less riskier than getting money after 3 months. All right. So money today can grow only through investing. So a delayed investment is a lost opportunity. If there is an opportunity, say the share market has come down, okay, or in fact even the power of compounding. You must have heard that the power of compounding. Warren Buffett often refers to it. What is this power of? If you start investing, or say in the share market at the age of 20 years, say you start investing whatever little you can save. Say you can save 5,000 rupees a month at the age of 20 years. You're not salaried. Okay, you get some pocket money. Whatever out of your pocket money, everything you are able to save 5,000 rupees, 5,000 rupees, 1,000 rupees, whatever you can save. You are saving and investing from the age of 20 itself. But if you don't start at 20 and you start at 30, and even if you double your investment from 5,000, you at the age of 30, you start investing 10,000 rupees a month. Still, the person who started at the age of 20 would be much better off. You can do the calculations on the spreadsheet and you will find that out. You will understand that I'm not joking. It is true. All right. So, delayed investment, if you delay 10 years, it is a loss of opportunity, loss of that compounding interest. Compounding interest basically means interest on top of interest. So for 10 years, you have already earned interest. Okay, so that amount has already grown. And from this level, it grows further. Okay, so say for example, if you are investing 100 rupees, 10% is the rate, then it will become 110 rupees next year. Then 10% is the rate, so that 10% will be levied on 110, not 100. So it won't be 110 and then 120. No, it is going to be 121. If there was simple interest, then 100, 110, 120. If there's compound interest, 100, 120, sorry, 100, 110, then 10% on that, 121. Okay, so loss opportunity. Inflation has a negative impact on time value of money because your purchasing power decreases as price increases. Already discussed it. Earlier the cash flow is received, the more certain they are, lesser risk of non-payment, already discussed. Now compounding, again already explained. So it is interest on top of interest. So amount invested today shall earn interest. Compounding helps calculate the interest and gives us the future value. If we invest, say, 100 rupees today, what is the future value after 5 years? In order to calculate that, you can use compounding. Okay, say for example, you are making a FD, it's at 5%, then 100 into 1 plus R raised to N. That's the formula. R being the annual rate of return. So 1 plus R would be 1 plus 5%, that is 1 point plus, or rather 1.05. Okay, and raised to N. N is the number of years. Now remember, the years is an annual thing. That is why my rate is also going to be annual. Okay, if you're going to write raised to months, then your interest rates would also be in months. So that denomination needs to match. But as a standard, we stick to years. Right? So raised to 5 years, and then you do the calculation, you will get the answer. That is the future value. That this 100 rupees today is worth, for example, it is worth 120 rupees after 5 years at a rate of 5%, assuming that it's growing at the rate of 5%. It may not be 120. Wait, let's just do the calculation very simply. Okay, let me just zoom this in for you all. So 100 into 1 plus R, that is 5%, raised to N, that is 5 years. It's 128. If you want to manually calculate it, what will you do? In year 0, that is today, it is 100. 1 year, 2 year, 3 year, 4 year, and 5 year. On this, you are doing a 10%, sorry, 5% increase. 1.5. Sorry, not 1.5, 1.05. Okay, so that's 105. Then you will just drag and drop this, and you will get the same answers. Right? 128, 128. How did we do that? On 100, 5% interest, on 105, 5% interest, on 110, 5% interest, on 122, 5% interest, so on and so forth. And we arrive. So you can either use this long way, which I wouldn't suggest, because there is a much shorter way of doing it. So future value is equal to present value into 1 plus R raised to N. 100 was the present value into 1 plus R, that is the rate of return, raised to N. Right? Coming back. So the formula we just discussed, future value is equal to PV into, or FV, the short for future value, and PV is a short for present value. So FV is equal to PV into 1 plus R raised to N. Or you can also present it as PV plus interest earned over N years. Right? Where FV stands for future value, PV for future present value, R for rate of interest earned, and N is the number of years. Now, an example, Basil invests $1,000 for 3 years in a savings account which pays 10% per annum. If Basil allows the interest income to be reinvested, okay, so you're kind of like compounding base implies that amount is reinvested. You are going to earn interest, and that interest earned you are going to reinvest as principal, and you are going to earn interest. The next interest you are going to earn is on old interest plus the principal. Okay, so here they have explicitly or in a different way mentioned that Basel allows the interest income to be reinvested. They haven't mentioned that it's compounded, but in a different way, they have said the same thing. Investment will grow as follows. So future value is equal to PV into 1 plus R raised to N. So PV is $1,000 into 1 plus R, R being 10%, that is 0.1. So 1 plus 0.1 is equal to 1.1 raised to 3 years. Okay, multiply it, get your answer, and you have the future value of this amount, which is currently $1,000. So now you would ask me, Paritosh, how can we use this in real life? Well, in real life, what you can do is you can use compounding and figure out, say there is another investment opportunity which is giving us, by investing $1,000 today, it is giving us just $1,200. So no, the future value is actually worth 1,331. I'll go with that other investment. Now, discounting is the exact opposite of compounding. With compounding, we had the present value and we were finding the future value. Discounting is we have the future value and we want to understand the present value. Now you will say, what sort of scenario would that be? How do I know the future first and don't know the present? Well, maybe your financial goals. Okay. Say you are planning to invest in some asset. Okay. Or even if not an asset, say you want to buy a car. All right. After 2 years, you want to buy a car and you feel that the price of this particular car after 2 years is going to be, say, $100,000 or $10,000. Okay. Now you feel the value of this car will be $10,000 after 2 years. What should the amount be that I need to invest today so that it can grow and become $10,000 after 2 years? Such an answer you will get with discounting because you know the future value is $10,000. Now you should discount it. Say if you know that the rate of interest that you can earn is 7%. So you're going to discount this $10,000 at the rate of 7% and find the present value. Then in the present, you can invest that value, earn 7% interest, and ultimately that amount is going to grow to $10,000 in future. Clear? Discounting means arriving at present value from something that you know is going to be there in future. From business point of view, they estimate. They don't see, nobody can predict future. So it's always an estimation or a forecast. So they forecast that, yeah, in year one, I'm going to sell this much. In year two, I'm going to earn this much. Three, I'm going to earn this much. Then they are going to discount it. What is the value of it today? Is it even worth investing? We are going to come to it shortly. It's called net present value. Anyways, for now, let's focus on discounting. So, long story short, discounting is calculating the present value from the future value which is available. Now, the formula remains the same, it just becomes an inverse. So, previously it was future value is equal to, previously it was present value is equal to future value into 1 plus R raised to N. The future value was present value into 1 plus R raised to N, which is the compounding formula. Discounting is the exact inverse of it. Now we are finding the present value. So present value is equal to future value into the inverse of 1 plus R raised to N. That is 1 divided by 1 plus R raised to N. Or you can say future value divided by 1 plus R raised to N. Anything, it's the same thing. Okay, so here's the formula. PV is equal to FV into 1 divided by 1 plus R raised to N, wherein 1 divided by 1 plus R raised to N is nothing but the discounting factor. It's termed as the discounting factor. So sometimes they'll just directly give you the discounting factor. You just have to multiply the future value into this. Do not use the discounting factor in the formula. The formula is the discounting factor. 1 divided by 1 plus R raised to N is the discounting factor. Okay, don't think that is R. R is the discounting rate or cost of capital or expected return. Another way of writing it is PV is equal to FV into 1 plus R raised to negative N or minus N, which basically implies that it's the inverse. All right. So moving on. Now, how do we discount different cash flows? Now, there are various types of cash flows. One is a single cash flow, as the name suggests, only one cash flow. Then multiple uneven cash flows. So year one, year two, year three, year four. Okay, the cash flows keep changing. Third one is an annuity. Annuity means year one, year two, year three, year four, but same cash flow. For example, pension. Okay, when you receive pension, year on year, you are going to receive the same amount. All right. Or there are certain schemes wherein you invest X amount of money every year for the next 10 years. And then after that, for the next 20 years, they'll give you fixed sum of money. Okay. So annuity is fixed sum of money over a fixed period of time. Advance annuities, delayed annuities means advance annuity means annuity received in advance, and delayed means annuity received in a delay with a lag. Perpetuity, as the name suggests, is perpetual, forever and ever. So fixed amount forever and ever and ever. Advance perpetuity means this fixed amount or this forever payment starts early. That is, it starts today. Delayed means it starts late. Now we'll go through how do we discount each of these various cash flows. First one being single cash flow. Single cash flow is super simple. Just use the formula, get your answer. So if you have to find the present value of $20,000, which is to be earned after 5 years. So for example, you need $20,000. Okay, now here they have said it's earned, but if you have to think of it this way, that you need $20,000 after 5 years, and how much do you need to invest today? And you know that you can earn 15% rate of interest. So PV is equal to FV into 1 plus R raised to N. I don't think there is any need to calculate this. It's very simple. Turns out to be 9,944. So if you invest $9,944 today, it is going to earn, and provided that it earns 15%, then it is going to grow to $20,000 after 5 years. This is the meaning of this. Question number 2, find out the present value of the following stream of cash flows to be received for 5 years. So year 1 is 20,000, 25,000, 38,000, 40,000, 42,000. Discounting rate is 8%. Okay, so let's just shift to the sheet. Okay, before we do that, let's just solve this compounding 5,000. So ABC has $5,000 to invest now for 6 years at an interest rate of 5% per year. What will be the value of investment after 6 years? Okay, so we have the present value, that is 5,000 to be invested now. So you can just write it. Now I'm in exam, you need not say, oh, present value is equal to $5,000. Okay. Then your future value will be this into, in fact, you should also write the rate. So rate or interest rate is equal to 5%. Okay, so future value will be equal to present value into 1 plus R raised to N. N is for 6 years. In fact, you could also write N as a variable, or you can just keep it like this. And always remember denomination. So you can write this is US dollars, then you can highlight it or make it bold so that the examiner knows, okay, this is the final answer. Clear? Very straightforward, very simple. Don't get too happy. You won't get questions like this in the exam. This is just the basics. I'm just refreshing your because a lot of times if the basics are not clear, you can't do the advanced calculations. Okay. And advanced calculation, all of that we have done in classes. Here, this is just what do you say, uh, free YouTube session. So I'm just discussing the basics and clearing of all concepts. Then discounting. Now this is the uneven cash flow. So we have 20, 25, 38, right? So what we can do is year one, so that's year two, year three, year four, year five. Okay. So I'm just copy pasting the formula. Then I have 20,000, 25,000, 38,000, 40,000, 42,000. Always label. Okay. So we'll write uh, PV calculation of present value for a stream of uneven future cash flows. All figures in dollar thousands. Okay, so I'm not writing $20,000. I'm just writing it as 20. Okay, so this is the cash flow, CF cash flow. Okay, then we need something called the discounting factor, DF. Okay, how do we calculate the discounting factor? 1 divided by 1 plus R. R is how much? 8% raised to N. Okay, always remember, put the brackets. So 1 plus R is like a unit, right? Then I'll just find the discounting factors this way and multiply the two. Okay, so this will become my present value. Okay, I can call this even future value. Okay, so future value, I discounted it. So $20 received after 1 year is actually worth $19 today. $25 received after 2 years is actually worth $21 today. All right, so on and so forth. Let me just format this better, bring them all in one alignment. Okay, $38 today is worth $30. $40 today is worth 49 20 sorry $29. Okay, and this also I can label that these are years. So I can then just bold these values as PV. Now, if in exam, when it comes for section A and B, where you have to find out, you have to discount values. Okay, you can either do it this way, or you can. So mostly you will be doing discounting when you are calculating NPV. You can use the NPV formula, or else you can use something known as the discounting factor table. I'll just show that. Just go to formula, just Google formula sheet for FMACCA. Okay. Click on the first link, which is on ACCA Global website. Okay. Even if you go to your study resources, you will find this. It's titled Exam Formula and Match Table. Just download this sheet. Okay. I'm just opening it. Okay. And you will find this sheet. Now, this is all the formulas which are given to you in the exam. Just zoom this in for you. All right. So, like EOQ formulas given, Miller or model formulas given, CAPM formulas given, asset beta formulas given, growth model, uh, Gordon's growth approximation formula, weighted average cost, Fisher's formula, PPPT, IRPT. Okay, all of that formulas are given, so you need not by heart anything. Then, for discounting, they have given you a present value table wherein the discounting rate and the periods are mentioned. So, for example, if you want to find out the discounting factor for, now the discounting rate is 8% for year one. So, find out 8% year one. So, it's 0.926. So 0.926. Okay. Then 8% year 2, 0.857, 0.857. Year 3, 0.794, 0.794. Okay. So this is how. So if you don't want to calculate it this way, just go to this formula sheet, copy paste the values or type it, whatever you find easier. All right. This is how we use the discounting factor table, and it will be provided to you in exam. Moving on. Yeah, so we did question 2. Annuities we haven't done yet. So discounting annuities. Let me just wait. Yep. Now an annuity is a fixed annual cash flow for a certain number of years. I've already explained annuity. So the cash flow is fixed and the tenure or the period is also fixed. So for example, you are to receive $1,000 every year or every month, okay, for the next 20 years. Annuity factor is the summation of all the individual discounting factor. So if you want to calculate annuity factor, you can just add up all the discounting factors and you will arrive at annuity factor. Okay, so let's just check that. If you had to find the annuity factor of all of these, what you would do is equal to sum. Okay, sum of all these discounting factors. So you got your annuity at 3.993. Okay, which means annuity at the rate of 8% for 5 years is 3.993. Let us verify that. This is an annuity table. So the next, when you scroll down, you will find another table which is titled the annuity table. So 8%, 5 years period, 3.993. The same thing we got. All right. So if you have to calculate annuity, you can calculate it this way, or else you can take the shortcut, open the annuity factor table, look at the value, multiply, get your answer, the end. Okay. A payment of $3,600 is to be made every year for 7 years. The first payment occurring in 1 year's time. The discounting rate is 8%. What is the PV of the annuity? So $3,600 you have to pay every year for the next 7 years. When does it start? It starts after 1 year's time. So from year 1 onwards, you are going to start paying $3,600 for whatever reason it is. All right. And if you want to know the present value of this, then you will discount all these cash flows for the next 7 years at the rate of 8% and get your answer. So question number 3. All right. So this is the same question. Now, one way of doing it is present value is equal to future value, that is $3,600 into the annuity factor. So the annuity factor for 8% for 7 years will be 8% 7 years. So that is 5.206. Okay, so into 5.206. Now, possibly, I'm glad this error came. So this, when we copy pasted, it wasn't in a number format. It would be in a text format. That's why the error came. So if I just manually type it 5.206, okay, I get my answer. Then I can format it. That is $18,741.6. Okay. Or else alternative is I make a table for 7 years. So year 1, okay, so I'll just 2, 3, 4, 5, 6, 7. Okay. What happened? 2, 3, 4, 5, 6, 7. All right. So I entered 7 years. Labels are important, and the cash flow is 3,600. Okay, it's actually an outflow. I'm not putting a minus sign. All right, then discounting factor at a rate of 8%. 1 divided by 1 plus R. R is 8% raised to N. Okay. Now remember, discounting factors are not dollars, as in they are not currency. They are just regular numbers. Okay. Now, irrespective whether you show 2 decimal, 3 decimal, it doesn't matter, because in calculation, when the system is calculating, it takes the entire value only, right? And I just have to multiply these cash flows. And if I just add all of them up, okay, I got the same answer. That is 18,743.6. Okay. Small rounding of error, because here they are taking the full number, whereas we took only 3, 4 decimals. Okay. But that's it. But majorly, it is the same thing. So there are 2 ways of doing it. Obviously, this one is the shorter way. You are directly using annuity factors over here, and you are finding that annuity factor from the table. Moving on, discounting perpetuities. Now, perpetuities, as I said, is a a fixed amount forever and ever, perpetual. So in such a case, the formula is the fixed cash flow into 1 divided by R. Not 1 plus R, 1 divided by R. And no raise to N, because there is no N. It's forever. All right. So that's the formula for perpetuities. Then there's something called perpetuities with growth. So for example, you are going to receive $1,000 every year, but this $1,000 is going to grow 5% every year. So if you receive $1,000 today, then you are going to receive $1,500, sorry, $1,050 after 1 year. Then after that, another 5% growth, so on and so forth. So in such a case, so basically it's growing at 5%, your cash flow, forever, that too. So in such a case, you are going to use fixed cash flow into 1 divided by R minus G. Rate, that is the R stands for interest rate and G stands for growth rate. Okay. Now, before we do advanced annuities and perpetuities, let's quickly solve that question. So discounting perpetuity, calculate the present value of following, assuming a 10% discount rate, $3,000 received in 1 year's time and forever. Okay, so your present value is going to be is equal to the fixed amount, that is $3,000, into 1 divided by R. R is 10%. Now you can either write it as 10% or 0.1 is the same thing, right? Why is this a percentage? Okay, so that's $30,000. Remember, denominators are important. And now $3,000 with a growth of 2%. So PV is equal to $3,000 into 1 divided by R minus G. R is 10% and G, that is, it's growing at 2%. Okay, so it's going to be Why is it a negative amount? $3,000 is here in 1 year's time. 1 divided by R minus. Okay, sorry. I forgot to put the percentage sign for 2. So this is a mistake. So if you are writing percentages, do not forget the sign. 37,500. Have the presence of mind, because how can the cash flow become negative? Here it is positive, and obviously it's going to become positive because I'm receiving money, $3,000 every year. Okay, so just remember 2%. Other way of doing it is $3,000 into 1 divided by, now 10% is 0.1 minus 0.02. Again, many people in hurry, they will write 0.2, 0.1 minus 0.2. No, it's 2% and 10%. So 0.1 and 0.02. 10% is nothing but 10 divided by 100. 2% is 2 divided by 100. Okay, so you will get the same answer. All right. Now, advance annuities. I think before we start with advance annuities, let's take a break. Just refresh yourself, and we will start with advance annuities and advance perpetuities and the rest of the chapter. Right? A 5 minutes break. All right, welcome back. So let's resume. Let me just zoom this. Okay. Yep. So advance annuities and perpetuities. The word advance means beforehand. All right. So normally, when we say annuity or perpetuity, it usually starts after a year or at the year end. Okay. So all those cash flows were starting from one onwards. But advance means it starts today itself at year zero. That is advance. So it can be annuity, it can be perpetuity. It is starting today itself, and then from year one onwards, it's normal, your regular annuity or regular perpetuity. So usually annuities and perpetuities start after 1 year, that is T1. In this case, annuities and perpetuities, that is in this case, as in advance annuities case, annuities and perpetuities start in year zero. Some regular or fixed cash flows may start today or at once or immediately. So these are the words that you will read in question to understand whether the annuity is starting today or later. Okay, if they say something like the cash flow starts today or at once or immediately, they are referring to it starting at year zero rather than 1 year's time. PV is equal to fixed cash flow because see, year zero is already in present value. So whatever year zero's amount is going to be, that you are going to take as it is into 1 plus annuity factor. That's the formula. Okay. Or fixed cash flow into 1 plus perpetuity factor. Now, how do we arrive at this formula? We'll discuss it a little later when we are solving a problem. I'll just explain to you how is this formula derived? Not that it's important from exam point of view, just for your understanding. This whole thing, whatever we are doing, is just for your understanding because NPV and IRR is an important topic in the exam. Okay, and if you don't know the basics of NPV and IRR, okay, then doing advanced calculation will become all the more challenging. So just covering the basics right now. All right. So yeah, this is just one illustration for. Wait, just a moment. Okay. In fact, rather than the illustration, I'll just show it to you what is happening over here. So, say let's just solve this question. Find the present value of the following cash flow: a 15-year annuity of $300 starting at once. Interest rates are 6%. Okay. So what is happening is starting at once. So starting today. Now, how do you arrive at the formula? The actual formula is PV is equal to annuity as of today plus annuity into annuity factor. See, annuity into annuity factor is year one onwards, the regular formula. But since it's starting from today, that needs to be added. Now, if you take annuity as of today as a common factor outside, then the formula turns out to be PV is equal to annuity into 1 plus annuity factor. And that's how the formula is derived. Okay. So 15-year annuity of $300 starting at once, interest rates are 6%. So $300, $300 into 1 plus annuity factor. What's the annuity factor? 6% for 15 years. So 6% for 15 years. So I think that is 9.712. 9.71. Okay. So your answer will be this much. 3,214. Okay. Wait, let me just check. Yeah, 6%, 6%, 15 years. 6%, 15 years, 9.71. Yeah. All right. So you will write PV of the annuity is equal to 3,214. So the value of that annuity today is 3,214. If you want to calculate it in a long way, what you will do? Normally we start from year 1, but now we are going to start from year 0 because we are going to receive it that day also. Then plus 1. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay, 15 years. What's the cash flow? The cash flow was $300. Okay, so this is year. This is the cash flow. That's 300. It's constant, so it's going to be the same throughout. Okay, so just right. Then we need the annuity factor, sorry, discounting factor. At what rate? At 6%, right? So, well, now the discounting factor as on year 0, there is no point discounting because this is already the present value. So it's going to be 300 only. Okay, this is the present value. All right. Then from this year, you can start 1 divided by 1. Remember, always remember, discounting factor would start from year 1 only because year 0 is already the value as of today. What are you going to discount? 1 divided by 1 plus R, which is 6%, raised to N. Right? So then I'll just copy paste the formula. Just multiply this into this. Okay. And then just add all of these up. 3214. Okay, slight rounding of differences are there, but majorly it is the same, right? So then you can, instead of making this bold, you can make this bold. So this is PV of the annuity, and this is also the PV of the annuity. This is PV of cash flows. Okay, individual present values. So these are all also dollars, right? And this is also dollar. Okay, and discounting factor, well, discounting factors are decimals. They are not an amount or anything of that sort. So these are two alternative ways of calculating PV of the annuity. So if you're doing the regular way, well, there is nothing extra that you need to do. You just need to understand that the cash flow is beginning from year 0 onwards. Okay, in this case, you are using the direct formula. In exam, I would suggest using the direct formula. It's simpler that way. I've pasted the table over here, so need not even go to this. It's the same thing basically. Okay, but there is this table available here. Now, and this is how the whole thing is happening. So normally this 300 is not there. Okay, it starts from year. This is how it normally starts. Okay, but for advance, it will start from year. That's the only difference. Same thing for perpetuity. Now in perpetuity, we cannot show it on in a table form. Why? Because it's forever. So you have to use the perpetuity formula. Okay, normal perpetuity 1 divided by R. If it's with growth, then 1 divided by R minus G. Over here, let's see. But this is advanced annuity. So perpetuity amount into 1 plus perpetuity factor. So perpetuity of 33,000 commencing immediately, interest are 22%. So is equal to $33,000 into 1 plus 1 divided by R. R is 22%. Sorry. Okay, there is no raise to n or anything. So I'll just put this in the same format. $183,000. All right, this is the PV of the perpetuity. Okay, I can also grade it. Just a matter of presentation. All right, so PV of annuity, PV of perpetuity. Moving on, delayed. Okay, we'll come to delayed shortly. So again, this perpetuity means it's starting from year 0. Normally, we won't be doing this plus 1. Okay, normally it is just this much. But since it is starting today, we are doing a plus 1, right? Wait, yeah, coming back. Now, delayed annuities and perpetuity. This can be confusing to a lot of students. Okay, it is a little difficult to understand in the first attempt. In this case, now, okay, rather than reading, let me just explain it first. Now, an annuity or perpetuity is getting delayed. So, which normally starts at 1 year or at the end of the first year, okay, is going to start maybe after 5 years. Say you are going to receive some annual payment for the next 10 years, but it is going to start after 5 years' time. So, what are you going to do? From calculation point of view, it's a two-step process. Step number 1 is just find the present value as you normally would. Okay, a 5-year annuity. Okay, just take the annuity, that is the fixed amount, into the annuity factor for 5 years. Okay, take that. Then step number 2 is you have to rediscount it. See, when you applied annuity factor, you have already discounted it. But step 2 is you have to rediscount it. Why do you have to rediscount it? Because it started on year 5. And when you are just applying regular annuity factor, it is giving you the present value as of year 4. See, normally when we start discounting, we are discounting from year 2. Let me just move to the sheet. Okay, let me just take this, or maybe did we take anything? Okay, this is only the annuity one. Wait, previously, yeah, okay, this is one annuity. Okay. Now, what I'm saying is when we did the discounting and everything, okay, we got the value as on, this is the present value. Okay, which means this basically means value as on year 0, that is today. Okay, now how did you understand that this is value as on year 0? Because you started discounting from year 1 onwards. So when you discount it, it's basically shifting 1 year prior, because you are raising it to 1. It's raised to 1, correct? So you're getting the amount as on year 0. However, if you start discounting from year 5 onwards, say I take the same thing. Okay. So this is 7 years from year, but from year 5 onwards, I'm going to start. All right. So 1, 2, 3, 4, 5, 6, 7. So what is happening is, all right. So year 1, 2, 3, 4, nothing is happening. Here 5, 6, 7, 8, 9, 10, 11 things are coming in. So if you have to do it from a table point of view, again, it becomes very simple. All you have to do, you have to just copy paste, but you need to have the presence of mind that it's starting from here. Okay, and then you will just say that the present value is equal to sum of all of these. Okay, so $13,777. All right, this is how you would do. That is the value as of year 0. Okay, because starting from year 5 onwards. Now, I understand that doing this whole big table becomes too much. And in fact, a question like this could come in 2 mark MCQ question. Okay, so it's not going to be a big question. So you won't even have access to spreadsheet. So therefore, there is a shortcut method or and lesser steps involved, which is this two-step method, wherein step number 1, apply the discounting factor, that is annuity factor in this case, since it's an annuity, to the relevant cash flow as if you are normally doing it, and then discount the above answer back to year 0, which means that if the annuity is starting from year 3, so what is the present value of $200 incurred each year for 4 years, starting in 3 years' time? So after 3 years, so from third year onwards, this annuity is starting. For how many years? 4 years. So from 1 year, 2 year, 3 year, 4 year. You are doing normal discounting. Okay. So $200 into the annuity factor, whatever the annuity factor is. Okay. So if you see the next step, $200 into the 4 years annuity factor at the rate of 5%, which is 3.564. So you get 709.2. Now this 709.2 is as of year 2, just 1 year before the annuity started. It's not as of year 0, it is as of year 2. That is why we have to rediscount it. Okay, so you are putting a 2-year discounting factor. So the next step is discount the answer to back to year 0. So 709.2 into 2 years discounting factor, multiply it, get your answer. So remember, in case of delayed annuities or delayed perpetuities, step number 1, do the calculation as normal. Step number 2, use further discount that value of year number 1 with a discounting factor of 1 minus the year. So if it's starting in year 3, then 1 minus the year is second year. 1 minus 3. Okay, so second year. Or 3 minus 1, whatever. All right. I hope the concept is clear. If it is not, you may want to rewind it a little, listen to it again, try to apply it. All this is only for the shortcut method. If you want to use the long method, then this is the calculation. But I do not suggest the long method because here, okay, it was 11 years. What if there is a 30-year annuity and it's delayed by, say, 20 years? Then 50 years you will have to plot. Actually, you just have to drag and drop, so it's not that big a deal. But in your MCQs, you are not given a spreadsheet, so you can't do 50 years. What you will do is, for 20 years, you will use normal annuity, and then you will do -1. So if it's so the question is, annuity starts after 20 years, but for the next 30 years. So 30 years annuity factor, step number 1, present value. So you take the annuity into 30 years annuity factor. That's step number 1. Step number 2 is rediscount it. So whatever value you got in step number 1, take that value, rediscount it at what discounting factor? At year 20 minus 1. Okay, that is 19. So at year 19, you will further discount it or rediscount it. All right. Now, before we move on to cost of capital, let us solve questions on these delayed annuity and perpetuity. Okay, I'll just keep this. This is some gap so you don't get confused. Okay, so it's not related to the question. You just made that disclosure there. Okay, delayed annuities and perpetuities. So find the present value of the following cash flows. A 15-year annuity of $300 starting at T3. Interest rates are 6%. Okay, so here they have clearly mentioned that it's starting at T3. So if you remember our steps, wait. Okay, T3 onwards. So firstly, we have to do annuity as usual. So it's a 15-year annuity. So annuity as usual would be, or rather, instead of writing normal PV of annuity, PV of annuity as on year 2. Okay, because it's starting on the third year. So as on year 2, 1 year prior to that, year 2. So it's $300 into the annuity factor, 6%, 15 years. So 6%, 15 years, 9.712. Okay. So $300 into 9.712. All right. That's 29, 300, 6%. Yeah. All right. So that's 2914. Now we further discount it. PV of annuity as of today. That is year 0. So now you have to multiply this with discounting factor of 2 years. That is 1 divided by 1 plus R. So 1 plus R is, what was R? 6%, right? So 1.06 raised to N. N is how many years? It will be 2 years. Okay, or 3 minus 1 because it's starting from third year. So just 1 year before that. So 3 minus 1. So this and 2593 is my final answer. So my final answer will be this. If you want, I can also, just for disclosure, as in like for your better understanding, discounting factor at the rate, oops, wait, at the rate of 6%. Okay. Rather, I'll just annuity. I'm just making it so that when you refer to this later also, you understand it. 300 annuity factor at a rate of 6% for 15 years is equal to, what was it? 6%, 15 years, 9.712. 9.712. Right? So this is nothing but this into this. Okay. Now remember, annuity factors are not a currency. So this is a normal number only, right? This is a dollar. So present value of annuity factor on year 2. This is step 1, right? So you can call this step 1. Okay. So this is your final answer. I just realized that the screen got changed. Um, I don't know why that happened, but yeah, I realized that and I've shifted it. I hope it wasn't gone for too long. Um, so yeah, that's your final answer. PV of the annuity will be 2,593. So step 1, let me just put it in italics. So you know there's a distinction. Okay, so each and every step I've broken down and written it so that when you later on refer to it, there is clarity. Now, this is subsection 1. Now, subsection 2. So the final answer is whatever I have made bold. Okay, I'll just mark it. So this is the final answer. In fact, let me just remove this because there could be confusion. Okay, just some so that you understand better. Now, a perpetuity of 33,000 commencing at T2, interest rates are 22%. Now, it's starting at T2, that means 1 year prior. So, further discounting at year one's discounting factor. So, firstly, calculate PV of perpetuity normally. Okay, so normally what you would do $33,000 into 1 divided by R. Okay, so $33,000 into 1 divided by R, which is 22%. Okay, remember always start it with is equal to sign. So this is the PV of the perpetuity as on year Okay, welcome back. Let's continue. Just a minute. Let me just shift myself. Yep. Um. So yeah. Now, cost of capital. See, in discounting, we used to discount at a rate. This rate usually was interest that we took. Now, in NPV, we would take something called cost of capital to discount the future cash flows of the business. Now, what is this cost of capital? When you study WACC, or in fact, since this is a revision session, I am sure you all have already studied WACC. Okay. This WACC rate is known as the cost of capital. WACC stands for weighted average cost of capital. So you can use that rate, that is WACC, to discount the cash flows. Or you can, if there is something called a discounting rate. So that's straightforward, just given that this is the discounting rate. You can use that. Or else something like a required return or expected return is given to you, which you can use as a discounting rate. All these three terms are used interchangeably. They all three can be, they are not different, they all are the same. Okay, I explained yesterday one person's return is the other person's cost. Okay, if you are investing in a FD, it is the interest that you earn is the return for you, but it is the cost to the bank because they have to pay you interest, right? So one person's return is the other person's cost. Therefore, expected return is equal to cost of capital. The provider of the capital is getting returns. The person who's utilizing that capital, for them it is a cost. Okay. Now, one more thing. Sometimes, like in the past questions, it has come wherein cost of capital is given, then cost of debt is given, and cost of equity also may be given. Okay, and they will say, and it's a NPV question. Now, students get confused which rate to use. Okay, so the rate you have to use, always remember, is the overall cost of capital, or WACC, weighted average cost of capital. Do not use individual cost of debt or individual cost of equity. It is usually assumed that, in fact, you can write this assumption, since it will be a big type C sort of question. You can write that uh, though the project is being funded by maybe just debt, okay, we are going to it is assumed that money or finance, or the capital used for this project is withdrawn from a pool of fund and not just the latest capital raised. All right. So when we say pool of fund, it means overall fund. So therefore, we use WACC as a discounting rate, which is an overall discounting rate. So alternative terms for the rate of interest, that is R, used to calculate present value, are called cost of capital, or WACC, which is weighted average cost, discounting rate, required return, or expected return. Whichever term used, R essentially reflects the average cost of finance that shall be invested in the project. What does this R represent? Ultimately, it is basically the cost. If so, it's saying that if I am to do business, all right, say the business requires $1 million. How much is this $1 million costing me? In order to raise $1 million, it's costing me, say, 10%. Then I am doing business. Year one, I'm earning money. Year two, I'm earning money. Year three, I'm earning money. After discounting, that means after taking consideration of that interest element of 10% or the cost element of 10%. See, not necessarily it's debt, it could be equity also. And we basically are taking back. So it's a mix of all the sources of finance. Okay. So keeping our costs in mind, do you think the project is still worthwhile? That is NPV, and net present value. We studied present value. What is net present value? Net present value is nothing but a summation of all the present values, all the inflows and outflows from today. Okay, that is an initial investment will happen today till the time you expect the project to last. Okay, so net present value is a technique of investment appraisal. Investment appraisal basically means that you are appraising an investment, you are evaluating an investment, you are trying to understand whether this investment would make sense for me financially or no. When will it make sense financially? When one of my objectives are met. Usually, the primary objective of for making profit making company is shareholders wealth maximization. Okay, so you need to invest in projects that will increase the wealth of your shareholders. And when we study later, you will find out that a NPV positive project is going to contribute to the increase in shareholders' wealth. All right. So NPV is an investment appraisal technique similar to, so ROCE was the only investment appraisal technique based on accounting profits. NPV, discounted payback or payback, IRR, all of these other techniques are based on cash flows. Okay, so in NPV, we are going to consider only relevant cash flow, not any cash flow, relevant cash flow. Again, we studied relevant cash flow and non-relevant cash flow in the basic session. Previous, as in for YouTube Live, we didn't have, but in the classroom, we have already done all of this. Okay. So yeah, NPV is equal to present value of net future cash flows minus the initial investment. Okay, it's the net. Net means something minus something. Net of your expenses. NPV is expressed in currency terms. So ROCE was expressed as a percentage. Remember, ROCE based on accounting profits. Only investment appraisal technique based on accounting profits. Rest all accounting appraisal techniques based on cash flow. So ROCE was based as a percentage. Payback period was basically a period in how many years are you breaking even. Okay. Then discounted payback period is the same thing, but with discounting applied to the cash flows, because one of the disadvantage of payback period was it wasn't taking time value of money into consideration. Therefore, discounted payback is kind of like a version 2.0, new, improved, better version. Okay, but still, it's just better than payback period. It's still not the best. One of the best sources or one of the best techniques of investment appraisal will be NPV. Okay. So wherever possible, if you have the data available and they have asked you to appraise a project, the best way, or in fact, sometimes in questions, they will ask you a type C question. They'll ask you to appraise the project in 3-4 methods. All right. Whatever conclusion you can draw from NPV technique, that conclusion needs to be given the most weightage. Why? Because it is the most superior technique of investment appraisal. NPV is expressed in currency. Yeah, so as I was saying, payback period is a period expressed in years or months. NPV is a currency amount, an absolute figure. How much worth is this project going to add to my value of the company? When the value of the company will increase, the shareholders' value will increase. Why? Because ultimately the shareholders own the company. They are the owners. So if the value of the owner's company increases, then it is implied that the value of the shareholders, that is the owners, also increases. Okay. So this is expressed in currency terms. So it could be pounds, euros, US dollar, Indian rupees, whatever. NPV impact shareholders' wealth. So I've written it in bold. Okay. So that is why it is superior technique of investment appraisal. NPV reflects the surplus unearned at the end of the project. How much money are you making at the end of the project? And remember, this is cash, hard cash, not profits. It's not measuring profits, it is measuring hard cash, because all the cash flows that you're going to take, for example, you're not going to take depreciation. There's a big confusion that, sometimes in MCQs, and a lot of people make this mistake that is tax allowable depreciation a relevant cash flow? That means, do we take tax allowable depreciation under consideration for NPV calculations? Okay, do we say that cash flow from sales, okay, minus cash flow from TAD, that is tax allowable depreciation, minus tax flow from expenses? Think about it. Maybe pause the video, think about it, give an answer to yourself, not to me. Okay. And then once you have thought of an answer, resume the video. Okay, so I'll just give you a moment to pause. Okay. Now resume the video. I hope you have an answer. The correct answer is TAD, or tax allowable depreciation, is not a relevant cash flow. Tax savings on TAD is a relevant cash flow. And this confusion, a lot of people in hurry, they all know about it, because when they are taking depreciation into consideration, it is only taken into consideration when you're calculating the tax savings on TAD, which is actually advanced level of investment, as in more. We are in the basic class right now. In the advanced level, you will learn that, in fact, since this is more of a revision, so I'm sure you already know all of these things. Okay, so in the advanced techniques, you are going to, or you must have already studied that tax savings on tax allowable depreciation is a relevant cash flow and gets added. Since it's a savings, money saved, so therefore it gets added, it's not subtracted. Okay, so keep that in mind. So whatever NPV basically reflects the surplus earned in cash form. Depreciation, all of that is not included. Therefore, it is different from profit, because in profit, they will take non-cash sales also, they will take non-cash expenses also. Non-cash income, non-cash expenses. However, in NPV, we are only going to take cash income, cash sales. Sorry, cash income, cash expenses. So if certain goods are sold on credit and money is not received, then it's not going to be shown as cash inflow. Okay, maybe next year it will be become a cash inflow, but only when you receive it does it become an inflow. So NPV reflects surplus unearned at the end of the project after considering the cost of funding. Okay, so normally, as in often students are confused, or they ask that, Paritosh, the interest is a cash outflow. Then why do we not take it in NPV calculation? It is cash. We are paying interest. You are very much correct. It is cash. We are paying interest. However, the effect of that interest or that cost is reflected in discounting process. See, at what rate are you discounting? You're discounting at the rate of the cost of capital. So why do you have to double do that calculation? Once you have already given the effect, so second time you need not give that effect. Okay, so the effect of interest cost and other equity cost, whatever cost of capital, is reflected in the process of discounting the cash flows. All right. Now, the decision rule is, if the NPV is greater than zero, we shall accept the project. That is, it is financially viable. If it is less than zero, we shall reject the project because it is not financially viable. It basically means that by doing this business, your cost of capital is more than what you are going to earn out of this project. And if NPV is zero, which means it's break even, then also you won't suggest the project. Okay, because why do so much work to earn nothing? Right? Now keep in mind that whatever NPV calculations are done, they are done on basis of, so the variables to a NPV calculation will be your cash flows. Now all the cash flows, whether it's a future after 1 year, this is the revenue or this is the cash sales. This will be the cash expenses. Year two, this will be the cash expense, cash inflows. Okay, all these are just estimates. So understand that these NPVs are calculated on estimates. All right. So your cash flows are forecasted or estimated. Even your cost of capital is forecasted or estimated. All right. Your cost of capital is also based on cost of equity, cost of debt, cost of preference shares. Okay. And cost of all of these are again estimates. So at the end, everything is an estimate. Okay. And you are estimating the NPV based on those estimates. That needs to be made aware to the examiner, that you understand it. All right. I think in the first class, I have given one comment also, just so that final conclusion. So just don't write that, oh, NPV is greater than zero, so go ahead with the project. Maybe you will earn 1 mark for it. But if the conclusion has 2 marks allotted, you will just earn one. Uh, so yeah, decision rule, select the project that generates maximum positive NPV. So if you had to compare different projects, then select the project with the maximum NPV. Assumptions used in NPV discounting, unless otherwise mentioned, to calculate NPV, we assume all cash flows occur either at the start or end of the year. See, practically cash flows occur anytime during the year, but for ease of calculation, we say start of the year or end of the year. So when we typically write year one, we basically mean that it is the beginning of year one or ending of year zero. Year two basically means that it is the ending of year one and beginning of year zero. So if today is 2023, so today will become year zero, year one will become 2024. Okay, that would be the end of 23 or the beginning of 24. So that is one base assumption that we make, that all cash flows occur either at the start or the end, not in between. Initial investment is done as of T0, that is today, and the first cash flow occurs after 1 year, or rather the end of this year or the beginning of year one. You have that. Basically, you invested today, then you are assuming that throughout the year you are doing business, and at the end of that year you are preparing your accounts or whatever, you are calculating your income, and that figure you are mentioning in the NPV calculation. So when we write T1, that's that value. Okay. Interest payments are cash flows but are not considered in NPV calculation, and it gets reflected in the discounting rate, that is the cost of capital. All right, we already discussed this, nothing much to discuss there. Advantages of NPV, time value of money is taken into consideration. We are discounting all the cash flows. Okay, so time value of money is taken into consideration. Then it is an absolute measure of return, which means the final figure, the NPV, is an absolute number. It is not a percentage. It is just going to tell you how much surplus you are going to earn, cash surplus you are going to earn if you undertake this project at the given cost of capital. Then it is based on cash flows and not accounting profits. It considers the entire life of the project and the timing of the cash flows. So even if the cash flow moves from, say, first year to the second year, or from second year to the third year, it is going to impact your NPV, the final answer. Okay, and the entire life of the project is considered. In payback period, that was one of the disadvantage, that the entire life of the project is not considered. In ROCE, the disadvantage was that timing of cash flow was not relevant. ROCE, the disadvantage was that it's based on accounting profits, but here it is based on cash flows. Positive NPV projects lead to increase in shareholders' wealth. A good ROCE was basically indicating profit maximization, but profit maximization is not the primary objective. The primary objective is shareholders' wealth maximization. Profit maximization is one of the ways in which shareholders' wealth may increase. There are several ways, but this is one of it. So, shareholders' wealth maximization is a much larger term. The disadvantage is NPV is difficult to explain. See, I took so much time just to cover the basics of NPV. Okay. So, to explain NPV to someone who doesn't understand discounting, who doesn't understand time value of money, okay, who doesn't understand cost of capital, they would not understand what NPV is. They'll find it very hard to understand what calculations you are doing. So many calculations are being done. So it is a little difficult to explain. It requires knowledge of cost of capital and time value of money. Only then can you calculate NPV. And it is a little complex to calculate. It is not as straightforward as payback or as ROC. Okay. Those are the only disadvantages for NPV. Now, in MCQ, you can be tested. They will just change one component and they will ask you what is the impact of it on the NPV. Okay, so I have just made like a small little chart for you. When everything else remains the same, if cash flow, as in basically what we are trying to say is all other variables remain same, only one variable is changing. Increase in cash flow will lead to an increase in NPV. Obviously, if money is going to increase, my surplus is also going to increase. And if money is going to, or my cash flows are going to reduce, then my NPV is also, or the surplus is also going to reduce. If the cost of capital is going to increase, then my surplus will reduce because my cost is going up. And if my cost of capital is going to reduce, that means in cheaper way I can get my capital. My costs are coming down. That means my surplus, that is my NPV, is going to increase. Okay. If cash inflow is delayed by a year, I'm getting some income, but unfortunately I didn't get it this year, I got it next year. Then as per time value of money, money today is more valuable than money later. So my surplus, if I would have received money today, my surplus would have been more, but I'm receiving it later. So my surplus is less. Okay, so if the cash flow is delayed by a year, my NPV is going to reduce. And if cash inflow is early by a year, I'm getting money today, more valuable. So more surplus. So NPV increases. If cash outflow is delayed by a year, I have to make a payment, a cost needs to be taken care of. And outflow gets delayed, so good. Because if I pay money out today, then I'm losing the opportunity to earn interest on it. So that's a good thing for me that I'm able to delay my costs. So delaying costs is a positive thing. It's going to increase my surplus because it is not as expensive later, looking at time value of money. Okay, it's the same. Like, for example, if you have to pay rent, now you missed it for whatever reasons, you are not able to pay it this month. You pay it after 2 months. Rent amount is not going to change. Don't put in inflation telling me, Paritosh, Are, but the same thing is going to cost more after a year. No, here the price is fixed. Okay, whatever you had to pay today, if it was say $1,000 outflow, instead of today, you have paid it after a year. Okay, but same $1,000. Just that the worth of $1,000 after 1 year is much lesser than what it is today. Therefore, the surplus or the NPV is going to increase. And similarly, if my outflow is prepaid, I am paying beforehand. Okay, then I am technically paying more due to time value of money. Okay, therefore my surplus will reduce, NPV decreases. And with this, I think we are done. Yes, there are no more slides. We are done with NPV. We'll just do a calculation which is based on NPV, the last question. And then we can move on to IRR, which is a small topic because it's super simple to do IRR calculations on the Excel sheet. So here they have given NPV, the cash flow for a project A has been estimated as follows: 0, 1, 2, 3, 4. 25,600. Okay. So these are the cash flows. Cost of capital is 6%. Calculate the NPV of the project to assess whether it should be undertaken or not. So let me just see if I can transpose. Okay, I am not able to do that. Okay, no. So I'll have to manually just write how many years are there? 4 years. So 4 years. And my cash flows are 25,000. So this is an initial investment. I can label it. Then cash flow 6, 10, 8, and 7. 6, 10, 8, and 7. In fact, I could have written everything in $1,000. So I could have just given a standard disclosure that everything is in 1,000, and then I would have written 25, 6, 10, 8, 7. Okay. Now, if you remember from yesterday, we can just use the NPV formula directly is equal to, so NPV at a rate of 6%, okay, is equal to NPV 6%. Sorry. Now, since this is another software, this is not the CB platform, so I'm getting prompts that how the formula is structured. So NPV, then the discounting rate, that's 6%, and then the cash flows. Okay. So all these cash flows. Remember, undiscounted cash flows. The mistake I made yesterday should not be repeated. Okay. Remember, again, cash flows from year one only. Only future values is what you're going to take, not the present value. Okay. And then you are going to take into consideration your initial investment, which gets subtracted. Okay. So $1,821 is your, or $822 is your final answer. Clear? As simple as that. NPV calculations has become so simple thanks to computer-based exams. Okay, you just have to do this, get your answer. And many times NPV calculations are asked. Obviously, it won't be as simple. There are those advanced, there will be sales is given. Sales may not be given upfront to you. Sometimes they will say that they will split the sales into credit sales, cash sales. Okay, so you have to do that calculation. Sometimes sales is given like sales units into selling price per unit, then selling price per unit is inflated at another rate. Then variable costs are there. Variable costs are inflating at another rate. Okay, many complications can be brought into the question. All right, and you need to adjust your discounting rate, whether it's real, nominal, all of that. Okay, they are advanced technique. This was just we just have 3 hours, and those techniques take time for understanding. So therefore, I chose a basic topic which we can complete within the stipulated time. All right. So NPV is a positive number. So our conclusion will be with the given cash flows or with the estimated, you can say given estimated with the given or with the given cash flows and discounting rate, which are forecasted, the NPV is positive, indicating that it is financially viable. We recommend accepting the project as the NPV is positive and it shall contribute to shareholders' wealth maximization. Now, I've written it in short form, but you understand how to write it. Okay. Let me just uh, wait, uh, formatting text wrap. Text wrap over here. Just a moment. What I'm trying to do is instead of one line, I want it to come down. That's called text wrapping. Okay. So now if I just extend this, all right, this is my final conclusion, and this is my, we can make this bold and highlight it so that they know what the NPV is. Again, this is a very basic question asked. There are a lot more complications which are added to it, and it will then come to your type C sort of questions. So this is not going to be that easy. All right. So yes, that brings us to the end of NPV. We'll take a quick 5 minutes break, and then we shall continue with IRR, and then we are done for the day. Okay. So quick 5 minutes break. All right, welcome back. So now we'll be doing investment appraisal techniques, IRR, right? So IRR stands for internal rate of return, which I think almost everyone knows by now. Okay. What is the meaning of IRR? It is that rate at which NPV is zero. You could use it like a proxy for your returns. Okay. Cash, it is a cash based method. It will take into consideration time value of money, right? So IRR is another project appraisal technique that considers time value of money and uses discounted cash flows. IRR gives us the discounting rate at which NPV is zero, which basically means that if your cost is equal to your return, then obviously NPV is going to become zero. All right. So IRR is that return rate, the break even rate. So IRR represents the break even cost of capital or the expected rate of return. That means this is the max your cost of capital can go, because beyond that, if your cost is greater than your IRR, then your NPV is going to turn negative. Okay. And you wouldn't recommend the project then. So therefore, the decision rule is IRR should always be greater than cost of capital. Only then can you accept the project, or else you would have to reject it. Why? Because if IRR is less than your cost of capital, for sure the NPV is going to be negative. Okay. Please note, if we use IRR for discounting future cash inflows, NPV will be zero. If we use a discounting rate that is less than IRR, then NPV will be positive. So we need a discounting rate, or rather, our cost of capital should always be less than IRR, right? Now, this is the linear interpolation method, which was the old school way of doing it when you were doing paper and pen, wherein IRR is equal to lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Ah, a very big formula. Okay. You just saw in yesterday's session, towards the very end, I showed you that on the CBA platform, fortunately, the IRR formula is active, and it is super simple to calculate IRR with that formula. Is equal to IRR, open bracket, select all the undiscounted cash flows, okay, including the initial investment, all of it, and that's it. You get your IRR. So it's very simple. So L, H, and L, all this stands for these things. Um, Now IRR of a perpetuity. See, I told you that you need to just mention all the cash flows, but perpetuity, the cash flow is for ever and ever and ever. How many cash flows are you going to mention? So for perpetuity purpose, the formula is IRR of a perpetuity equals annual inflow divided by initial investment into 100. That's it. Okay, as simple as that. What is the inflow? That is what returns are you making, and what is the expense that you incur to earn these income. Like a typical return formula it is. Okay. Um, so for example, like I just want to make you understand the simplicity of this formula. Say for example, you have invested 100 rupees, and on that 100 rupees you are getting 10 rupees as return. So what you will do, if you want to calculate how much percent are you returning, 10, that is your return, divided by what you invested 100. So 10% return. So same thing over here, annual inflow. But only thing is annual inflow is forever. The initial investment is one time. Okay. So annual inflow divided by initial investment into 100 will give you the IRR of the perpetuity. All right. So for example, calculate the IRR. Find the IRR of an investment that costs $20,000 and generates $1,600 for an indefinitely long period. That means perpetuity, forever and ever. 1,600 inflow divided by your initial investment, that's 20,000 into 100 is equal to 8%. Now, calculating the IRR with annuity, the formula becomes if all cash flows are the same. See, uh, this honestly doesn't make any difference if you're doing it on if you're doing it on a spreadsheet. Why? Because if it's a 5-year annuity, who cares whether it's a 5-year annuity or whether it's 5 years of uneven cash flow? Your formula is equal to IRR, select all cash flow, and the end. Okay. But say, for example, you don't have access to the spreadsheet and you are doing it on calculator very quickly, you can just do initial cost divided by annual inflow. Okay, so first you have to do this initial cost divided by annual inflow. Then you have to go to the annuity table, look for which percentage this value represents. Okay, and that percentage will be your IRR. So let me just give you an example. Say, is this the annuity factor table? Yes. Okay. Say that figure, which is initial cost divided by annual inflow, turns out to be 5.206. And it is a 7-year annuity. That means 7-year annuity, 5.206, the percentage is 8. Okay, that means your IRR is 8%. Right? So as simple as that. So this is the annuity. Wait, let me just. This is the annuity table. I've just pasted it here. Advantages of IRR. Time value of money is taken into consideration. It is easily understood, unlike NPV, because it's a percentage. In fact, IRR is very frequently used term in like if you are reading any report, anything related to finance, you will often come across this figure IRR. It is based on cash flows. It is not based on accounting profit. It is not it's not like ROCE. Considers the entire life of the project as well as the timing of the cash flow. So even if you change, okay, the timing of the cash flow. Wait just a moment. I just wanted to show you that if I change the timing of the cash flows, my NPV gets. So instead of getting 6,000 in year 1, okay, I get 6,000 in year 2. So in year 1, I don't get anything, but in year 2, I'm getting 16,000. Okay, so if you see, my NPV has reduced. Previously, it was 1,822, but just because now this is 0, it has become 1,500. So from $1,600 or 622, it has dropped to 1,500. So the timing of the cash flow matters. Why does it matter? Because we are looking at time value of money. So if there is any delay, and similarly, if I am to receive this $10,000 earlier, so say I'm getting 16,000 here and $0 here, then my NPV automatically improves because money today is more valuable, so my surplus increases. Okay, if my cost of capital from 6% goes up to 10%, then my NPV reduces. Why? Because my cost has gone up. But if my cost improves, that is, it drops to 4%, then my NPV will improve. All right. So similarly, even for IRR, if I have to find the IRR of this, equal to IRR of all the cash flows. So now, wait, basically I need over here 25,000. Okay. Let me just, okay, I'll delete it later. Okay, I need the initial investment as a cash flow as well with the sign, as in that's a outflow. Okay, so 9% is my basically how much 9.1. Okay, 9.1% is my IRR. So the moment I'll change this to 9.1%, okay, or if I just make it exactly whatever the value of the cell is, because it's not exactly 9.1, then my NPV is 0. So IRR is that rate at which NPV is 0, which means if my cost of capital is equal to 9.1%, then I'm going to break even. If my cost of capital is going to be more than 9.1%, then there will be losses in this project. But fortunately, the cost of capital is not 9%, it is 6%. Okay, and it is making surplus. But if costs have to go up, then we could be in trouble. That is, especially if it goes up beyond 9%. I'll just close this. Yeah. So what I was saying, yeah. So it considers the entire life of the project and the timing of the cash flow. Projects with IRR greater than WACC shall lead to an increase in shareholders' wealth. Okay, so even IRR is linked with shareholders' wealth maximization. Disadvantage is now it gives a break-even point and is not a measure of absolute profitability. All IRR gives is the break-even point. Okay, it does not give you absolute. So when we say absolute profitability, it does not give you the amount of profit. Okay, your investment would be $10. On that, 10% is $1, but on $1 million, 10% is a much bigger value, is $100,000. Okay, so that idea you don't get in IRR. Interpolation method only provides an estimate. It is complicated to calculate. Well, that is when you do it on paper pen, but on the spreadsheet, it becomes easy to calculate. Nonetheless, the background calculation is very complex. Inherent assumption that cash returns earned shall be reinvested at projects IRR. So there is one inbuilt assumption in IRR method wherein it is assumed that after year one, whatever money you make is reinvested and you earn exactly IRR returns, not more, not less. That is just an assumption. That's how IRR functions. Okay, so this is an unrealistic assumption, therefore, it is a disadvantage. Also, another disadvantage is that there can be multiple IRRs in case of non-conventional cash flows. Now, what do you mean by non-conventional? See, conventional cash flow means initially there is an outflow and then there are multiple inflows. Non-conventional cash flow means that there are more than one outflows. Okay, so more than one sign change is happening. That's non-conventional. And each time the sign changes, that many IRRs. So if there are three outflows, that is, there are three sign changes, that means there can be three IRRs. It could be 0, 1, 2, 3, any number of IRRs you can have. And then it gets super confusing. Like for I've just given an example. If it's 10,000, 23,000, and 13,000, then both 10% and 20% are the IRR. Okay. So at 10% discounting also NPV will be 0, and at 20% IRR also or 20% discounting also NPV will be 0. Then it becomes very difficult to compare which should I, if my cost of capital is say 15%. Well, if I'm to take 10% as my IRR, then at 15%, I would say, oh, IRR is greater than the cost. Sorry, IRR is 10, so 15, so it's smaller. IRR is smaller than the cost. So you will say reject the project. But if you take 20% as your IRR, then you will say, yes, my IRR is greater than the cost, so accept the project. So you don't know which um, IRR to take. So it becomes difficult to understand that. Multiple IRR. Now, a company is considering a 2-year project which has two. Okay, this is just one question. This is a tricky question because there are more to IRR. Okay, you also have to see that the summation of discounted cash flow, whether they are positive or negative. Okay, if the summation of, if you see this particular example, the summation, so 10,000 outflow, then 23,000 inflow, then 13,000 inflow, outflow again. So it's actually the summation becomes 0. Okay, so in that case, your IRR curve is like this. Or even if it is a negative one, it will be like this. The summation of all the cash flow, if it is negative, your IRR curve is going to look like this. However, if you have multiple IRRs and the discounted cash flow is a positive one, then the curve is going to be U-shaped. That means between 10 and 25%, these two rates, your NPV is going to be negative, and anything less than 10% and anything more than 25% is going to be positive. Okay, it's going to be a U shaped. If you just Google, um, I don't know if it will come or not. Let's just try. Okay. Mm, not clearly shown. I think this is the one. It's like this a little. Okay, so you get it. It's literally the inverted version of what we have on our book. Okay, so that is why IRR gets complicated when we have the moment you have more than one or non-conventional cash flow, that is a more than one outflow. Okay, because normally there are inflows and then sign changes outflow. So year zero, mostly there is an outflow. Then it's inflow. But in case if it is a net outflow, then IRR cannot be used. So the question is, a company is considering a 2-year project which has two annual interest rates, namely 10% and 25%. The sum of undiscounted cash flow is positive. Since this word positive is given, that is why the curve is like this. It's a U-shaped curve. Okay. So whatever is between 10% and 25% is on the lower end. So that's negative curve. Anything above 10% and above 25% will be a positive NPV. And they are asking, a project will necessarily have a positive NPV when the annual cost of capital is either more than 25 or less than 10. This is more than 10. That's why that's not our answer. Okay. If it is 10 and between 10 and 25, then it's going to be negative. And if it is less than 25, it's going to be negative. Okay. However, if the sum was a negative number, then our curve would be like this. Okay. It would be like an N. Okay. Or an inverted U. In such a case, between these two, if the cost of capital is between these two rates, only then will it be positive. It is less than 10 and greater than 25, then it will be negative. Only between 10 and 25, it will be positive NPV. That is provided that the sum of the undiscounted cash flow is negative. But in this question, it is positive. So there's this tricky part. That's why I included this. Now, if you have to compare NPV and IRR, both NPV and IRR takes into account time value of money and are superior techniques of investment appraisal. But if you have to select between NPV and IRR, I would suggest stick to NPV. NPV, being an absolute measure, reflects the absolute increase in shareholders' wealth as a result of accepting the project at the current cost of capital. IRR only tells us how much the cost of capital can increase if the project would not be able to cover its cost of capital. It's just the break-even rate. Only NPV can help select between mutually exclusive projects. That is, in case where only one of the two projects can be undertaken. So if you have to select from two projects, okay, either or, you cannot do both, then select. You can't say that, oh, this project's IRR is greater, so let me go ahead with that. Okay, that may lead to a wrong decision, because see, if you go ahead with that logic, what could happen? Let me give you one practical example. Say there are two projects. One project, the investment is worth $1 million. The other project, the investment is worth $100,000. Now, the project with $100,000 is giving you 10% return, and the project with $1 million investment is giving you 5% return, half the return. Okay. Now, $1 million, 5% will be $500,000. Okay. But $100,000, 10, okay, now the 10% who turns out to be $10,000. Okay. But say $1 million investment is giving you 9% return. All right. So what is going to happen is, it is going to, no, in fact, it would work out like, wait, let me just calculate it. Say there is a project $1 million and there is $100,000. Okay, one is giving you 10%, other one is giving you 5%. So what is the returns that you are making? Yeah, this is more. Sorry, I wrote it ulta. 10% is this. Okay. So this is a 50,000 return. Sorry, not 5,000. 50,000 return, and this is a 10,000 return. Right? These are dollars. Okay, and these are also dollars. Let me just zoom this in for you. All right. Now from IRR, like if you think from returns point of view, you will say, oh, 10% return, very good, go ahead with it. Now you're understanding why we cannot use IRR when we are selecting. It's not the best indicator. Appears that it's better, but in absolute value terms, this is actually better. Shareholders' wealth will get more maximized with this project and not this project, though the investment is also more. Okay. So, yeah, sorry. That is why we avoid using. Now, there can be arguments saying that, but investment is low, so I can invest in some other project. Well, you don't know what is the returns of the other project. So, if it is just this or this, either or, then use NPV. Okay, mutually exclusive mean either or. You can't do both together. Therefore, NPV is a better technique. Now, NPV versus IRR, a profile of project A is such that it has lower IRR, and applying the IRR rule would prefer project B. However, in absolute terms, A has higher NPV at the company's cost of capital and should therefore be preferred. So there is this diagram wherein there are two projects, project A and project B. Now, project B gives an NPV of this much, project A gives an NPV of this much. However, from IRR point of view, project A is better than B. Okay, so if you would just look at uh, IRR, you would select that, oh, project B is higher over here, so you will go for project B. But the NPV of project A is better, so you will select NPV, you will give more weightage to NPV, and therefore you will select project A. Okay, with this, we are done with IRR chapter. As I said, it is a small chapter. We'll just quickly do the calculations relating to IRR. It's super simple, and then we are done for the day. So business undertakes a high risk investment and requires a minimum expected return of 17% per year on its investment proposed. Calculate investment capital investment has the following expected cash flows. Calculate the NPV of the project. If the cost of capital is 15%, calculate NPV of the project if the cost of capital is 20%. Use NPV as you have calculated the estimate to estimate the IRR of the project, and recommend on financial grounds alone whether this project should go ahead or not. Actually, this question is from a old style of paper. That's why they have asked lower rate, higher rate, and all of that. But in now you may not be asked all of this. You can just go with IRR. So the point number 3, you need to calculate IRR. Okay. So IRR is equal to IRR bracket open. Select all the cash flows. Sure. Okay, and now you don't panic. It's not zero. Put it as a percentage. Okay, so that's 18.6%. That's the IRR. All right. If I had to calculate NPV, now if I have to answer subsection 1 and 2, then very simple. NPV at 15%. Okay, so is equal to NPV bracket open 15%. Sorry, 15%. Remember to put the percentage sign. Then select all the cash flows. Remember only the future values, and then initial investment needs to be adjusted. Okay, so that's $3,424. Okay, then NPV at 20%. You see, on a spreadsheet, everything becomes so much simpler. So many shortcuts can be used. You can, in fact, just copy paste this. Now, if you drag and drop it, like if you say this, copy it over here, the answer will be wrong. Why will it be wrong? Because it's taking different values. It's taking this, it's not taking 18,000. Okay. So what you will have to do is you can select over here on the text, the formula bar, just copy this part out, Control C, and again in the formula bar, do Control V. From 15%, just change 20% because our cash flow remains same. Okay, 20%. So that's 1,242. So at 20%, it is negative. At 15%, it is positive. That means IRR is between the two. And that's how the interpolation method functions. Okay. But we can, if you just want to verify whether your NPV at IRR. So again, you can just copy paste that same formula. Okay. And instead of 15%, it becomes the IRR rate. That's $0. All right. So simple. This question back in the days used to take time. Calculation is simple, as in, though the calculations are not that difficult, but it takes time. Now, find the IRR of an investment of $50,000 if the inflows are 5,000 in perpetuity, 8060 for 8 years. So, perpetual discounting, what was the formula? See, even I don't remember formulas by heart. Okay. So, annual inflow divided by annual initial investment. So, annual inflow is $5,000 divided by initial investment. That's $50,000 into 100. Be careful about the, so it's 10%. Okay. If I do not do into 100, I can just leave it like this. And then I can put in the percentage sign. So it's 10%. If you are doing into 100, which is there in the formula, into 100, okay. And then if you are just in formatting, because see, if I do this into 100, then my percentage is going to come 1,000. So have that presence of mind and understand that no, I need not add blindly follow a formula. Okay, this is for paper pen formula, wherein you could just put the percentage sign manually. And if you want to follow this, what you can do is, if it is already a numerical numbering system, you can do 10%. Okay, and you just put the percentage sign in the next cell and you will get the same answer. All right. So I'll just come back to this. Okay. So this is the IRR of perpetuity. Now IRR of annuity, I had to find, would be, now for annuity, it's a two-step process. So firstly, it's initial cost by initial inflow. So initial cost is 50,000 divided by inflow. Okay, so now this is not a percentage, this is a number. Okay, so 6.2. Now I have to come over here. I have to find out that how many years is this? This is for 8 years. So in the 8 years section, I have to find out which number has 6.2. So I can see that 6% has 6.21. Okay, so I can say that IRR at annuity is 6%. Approx. Because it should be 6.21, but it's 6.2. But okay, fine, no problem. So you can say that the IRR of annuity will be 6%. Okay, clear? As simple as that. You have to use. So step one is to find this out. Step two is to find out that this value represents which percentage. You already have the years. Okay, you just have to find the percentage. So in 8th year row, you will find which one has 6.2. So this is 6.4. This is more closer to 6.2. So we are going to take this 6% approximately. Okay. And then the last question. Now the last question, I've already solved it because it could take time, and it is all appraisal techniques, and some of the techniques we haven't discussed today. Okay, but nonetheless, I've given the entire solution over here, so I won't be solving it. ABC company is contemplating between two available investment opportunities, the cash flows of which are given below. Uh, so you have two projects, the cash flows are there. So initial investment, then year 1, 2, 3, 4, 5. In each case, the initial investment represents the purchase of a plant and equipment whose realizable value will be 20% of initial cost receivable in the addition to above flow at the end of the life of project. Now, a lot of students, they forget to read all of this, okay, or they just say, oh, okay, realizable value is 20%, and they are busy calculating all these things and they just forget, or they just take cash flow copy and paste. But at the end, there is going to be a scrap amount. So you need to take that into consideration. So if you see this as my NPV, okay, so I have taken, what has this happened? Yeah, I have taken this NPV B44. So B44, yeah. I have taken all of these cash flows, and to that I have added the scrap. Okay, so if you see now how ARR is calculated, so this is the formula for ARR. Okay, so you take initial investment, scrap value, you find out total depreciation, then you find out total cash flows, then total profits, average profit, because understand these all are cash flows. And for ARR, we need profit. Okay, so we are going to take the depreciation part and going to reduce our profits accordingly. This is how you do it. So you take your average profit, average investment, you can find your ARR or ROCE. Same thing you repeat for project Y. Okay, so I've very well highlighted. So people just know that, yes, I have to focus on these values. Payback period, again, with the calculation, well, we won't be going through payback, but this is how the calculation is done. It's basically in how many years will you break even. So initially there's a 125 outflow, then 50 inflow, which means that net effect is 75 outflow, then another 50 inflow, which is net effect is 25 outflow, then another 50 inflow, net effect of which is positive 25. Now you don't want positive, you want break even point. So that means it is between 2 and 3. Okay, so you have to reduce another 25 from here to reach 0. Okay, so using, if 1 year, in 1 year it is growing by 50, see, minus 25 to 25 is 50. Okay, then in how many years are you going to get 25? Because you need only 25 more to break even. So then you just cross multiply it and you find out that it is 0.5 years. So it's going to take you 2 years for sure, and then 0.5. So 2.5 years for you to get your money back. So the discount, for not discounted, but the uh, yeah, this is the regular payback period. Okay, so the regular payback period will be 2.5. Same thing you will use for the other project. Now NPV, okay, I have just used the direct formula. NPV is equal to 10% of the cash flows plus that last cash flow that I am getting. Okay, scrap value. It's B33. So B33 is 33. Okay. Okay. Already over here, when I was taking year 4 cash flow, okay, I have taken 50 already included, that scrap value that we were receiving. Okay. No, 50 is the regular cash inflow. Scrap value is, I think, B13. What is B13? Yeah, scrap value over here, 25. Okay. So in NPV, I'm taking these cash flows, in which I've already year 4, I've included that scrap. So taking that and then minusing B33, which is nothing but initial investment. Because remember, in NPV calculation, we do not include that initial investment. We have to adjust it at the end. Okay, so that's how it is done. Ignore this array constraints and everything. If you just, like, even if you remove all of this, you will get the same answer. Okay, $50, right? And this also, I don't know how it came in the first place. $66. Okay. And then in IRR over here, actually, I shouldn't have marked this because, so when you compare the projects on ARR basis, project Y is more favorable because higher returns, ROCE. If you compare it with payback period, then project X is favorable because you get money quicker. But if you're comparing it with NPV, then this is better. And if IRR, then this is better. Okay, so you need to make a comment accordingly. This is just like a confirmation that at IRR rates, the NPV is 0. Just to like a double check whether your IRR is correct. So that's a nice practice to double check that whatever calculation, mostly it won't be wrong because you are using the direct formula. But just in case, if you want to double check, you can do it using this. And then since this is the most favored method, okay, we will go for this $66, okay, or $66,000, whatever it is, right? Yeah, so these are all in $1,000. So $66,000. So we will say that NPV is positive. We can go ahead. You can basically give a conclusion in every. If you're following the ARR method, then it is 45.56% is the better ROCE. Okay, then in payback period, but again, there are limitations. So you need to highlight the limitations of ROCE method, that why you are not relying on ARR, why you are not relying on payback, why you are not relying on IRR, and why are you relying on NPV. Okay, so you need to give all of that. So yes, that brings us to the end of today's session. We'll meet tomorrow. As planned, today we discussed some theory topics, not theory, but one topic. From tomorrow onwards, we will be solving more questions because if you remember in day 1, practice, 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 practice makes one perfect. Okay, so tomorrow we will try to solve 3 type C questions. So those big 20 mark questions, we will try to solve those. All right. So same time, that is 10:30 Indian Standard Time. We'll meet tomorrow. Have a great day ahead. See you all.